the big realization will be that CRE is not monolithic and that this wasn't a single cycle, but maybe several overlapping ones.
Welcome to the TreppWire Podcast, the show where commercial real estate meets data and insights. This is a special guest podcast. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, Chief Product Officer. Today, we are joined by Marty Allen, Head of Capital Markets at Grandbridge Real Estate Capital, a Truist company. Marty oversees capital markets strategy across agency, CMBS, and institutional lending, and is leading Grandbridge's expansion into master and special servicing at a pivotal moment in the CRE credit cycle. Marty, we're so excited to hear from you today. Welcome to our show.
Great, I'm excited to be here.
So let me hear from your perspective about your background and how you got your start in commercial real estate. And then talk to us about what led you to capital markets at Grandbridge.
Yeah, sure. So even though it sort of seems like many people I meet in this business have been working in CRE since they were toddlers, I've had a bit of a different path. I spent my early post-MBA career in investment banking and M&A. But then in 2014, I transitioned to be the CFO of the commercial real estate line of business at SunTrust, one of the predecessor companies to Truist. A couple of years after that, we expanded our CRE business line by buying a company focused on mortgage banking and agency lending and commercial mortgage servicing. And then I moved into that in a business role in that newly acquired entity. Then 2019 came, and that's when SunTrust and BB&T merged to form Truist. And both banks had a mortgage banking and servicing entity that were then merged together under the Grandbridge name, and that's where we are today. In those combined organizations, I had various roles with responsibilities in business development and strategy and operations, production. All of that culminated a few years ago into my current role as the head of capital markets at Grandbridge.
Yeah, that's great. For our listeners out there, you gave us a little bit of an understanding of Grandbridge and through some of the mergers and acquisitions and how it kind of came to be. Maybe take just a little bit longer, if you don't mind, and kind of give us an understanding of where do you guys sit? You're still part of Truist. You know, how do you define capital markets? Because I think that's a term in the commercial real estate landscape that has about 100 different definitions, depending on what firm you're working at and where you sit. So just give us a little more color on that, and then we'll kind of get into the meat and potatoes here of the podcast.
Yeah, sure. So we are definitely a wholly owned sub of Truist, Grandbridge is. And, Grandbridge has been sort of a middle market commercial mortgage banking firm for a long time, but we always had a core focus on servicing. And, in the past several years, our commercial mortgage banking business has become much more aligned with Truist Bank, and the borrowers are much more of a match for the Truist CRE client profile now, which tends to be larger deals, much more institutional borrowers than we had previously in our middle market focus. We've also focused the last several years on maximizing the third party servicing aspects of the business, whether that be for debt funds or life cos or other banks. And given that focus, the next logical step for us has been to bring us where we are today with our launch of master and special servicing capabilities. Capital markets for us, it's a lot of different things are under that title. Any non-agency loan placement comes through my team in capital markets. Business development for servicing is covered there. Trading for our primary Fannie and Ginnie securities is covered there. Closing is under there. Strategic new business development. So we glom a lot of things under that capital markets title.
Yeah, that's great. And that's what I figured is, some people, when they hear capital markets, they think just the origination side of the business, or they think maybe investment sales. But I suspected that it had a lot more under the umbrella there, which you've highlighted. And, maybe a follow-up question on the transition from middle markets to more of the institutional players. I mean, just operationally, how does that change the business? I mean, obviously, for people, they may think underwriting and servicing and origination and all these things are the same across the spectrum. But I would suspect, depending on where you're at in the food chain, middle markets maybe have a little different nuance than the institutional focus. Have you guys seen any differences, and what does that look like for you all?
Yeah, it does. It was a shift to a different model for us. We have a large part of Grandbridge today that acts as a product partner to our commercial real estate business. And, that was the biggest shift when we made that change a few years ago. And instead of that middle market, bring in clients from all over the country. In that middle market space, we've become much more partners with our CRE bankers on the Truist side, and we're there anytime that those CRE clients need something outside of a bank balance sheet loan.
Yeah, that's great. And you guys have a lot more experience and flexibility and understanding. And I think, going up the food chain to the institutional stuff is a natural progression, but still rooted in that middle market kind of toughness, boots on the ground, understanding of how, like you said, you have to partner with folks in those deals. So let's transition a little bit to the servicing stuff, because I know that's been an area of focus. Maybe before we get into some of the direct questions around that, what's the impetus? What is the timing right now? Is this something that you mentioned that you guys have been known for doing at some level on servicing? Like, is the master and special? What's driving your guys' interest in this part of the market?
Yeah, so I think there's a lot of things there in that question, but like I mentioned, we've been in commercial mortgage servicing for a long time, over 30 years, and we do see this as a natural extension of our current platform. And if you look at market conditions, we think they're very conducive for a new entrant. There's been outsized growth in SASB originations that continues to increase the size of the market. But over that time prior to our launch, and you've only had 3 full service master servicers. And if you compare that to pre-GFC days, where you would see 10 or so different master servicers in the market, it's definitely much more limited, especially when you look at the fact that in some of those 3 specialize more in either SASB or conduit. And so for many deals, you're really down to 2 viable bidders sometimes. A couple of years ago, you had one of the rating agencies called out the lack of enough master servicing participants as a risk to market stability for CMBS. So we looked at those current market conditions showing this need for a new entrant. We see a real alignment with our strategy, and we decided that this was the right time to launch master and special servicing.
Yeah, it sounds like it. I mean, I agree with you. I think there's not been a lot of optionality in the marketplace, and you guys coming in with your experience obviously add another dimension to that offering for market participants. So I think the timing is right. And also, notwithstanding the macro backdrop of there's a lot of disruption in the space right now. So, I mean, what are you guys seeing? What's maybe the house view or the 30,000 foot view on just where we are in the CRE cycle broadly now?
We're definitely we feel like we're in a recovery phase, but, us moving in now is not really a statement about market cycle timing for us. We don't try to speculate around our, business strategy around that, but we see this as more about implementing our strategy of building a complete servicing platform and meeting more of our clients' needs. However, we do like the defensive nature of master servicing that comes along with longer term 5 and 10 year conduit deals and building a portfolio there. And we like the counter cyclical aspects that advancing and special servicing brings. So yeah, the phase of the cycle wasn't a main driver for us, but our move is encouraged by the cycle protection.
Yeah, no, I think that's valid for the reasons you mentioned on the front end of just lack of optionality. That's irrespective of market timing, but the timing here could be potentially good in the sense that there's a lot of stuff that needs to be worked through the system. You mentioned a couple of other things that I think are interesting and have been talking points. This transition from conduit to SASB, there's been a lot of SASB issuance over the last couple of years. And everyone has a slightly different opinion on if that's good for the market or if it's not good for the market, or if some of these deals that are being, originated as SASBs even should be a SASB deal. So I don't know if you have any SASB soapbox you want to pontificate on. That'd be great.
Well, the deals do seem to get smaller and smaller, right? A lot of deals that you would have thought previously would have been in a conduit or in maybe multiple, split between a couple of conduit deals. But yeah, I think we're new enough in it that we're taking it as it comes and saying, let's see how each of these deals goes as we bring them on. We're happy to see the growth in SASB. We do have a strong institutional lending platform in Truist CRE book, and we have strong relationships with a lot of the SASB borrowers out there. And the SASB for master servicing, SASB is very much a relationship business. And so we feel like that's going to help us in our launch and play in our favor. So definitely happy to see that and very interested to watch and see how the market transitions as that, those sizes of those deals do change and get smaller and smaller as we continue.
Yeah, it's interesting to watch. And, obviously the transition from 10-year terms to 5-year terms that creates some benefit for borrowers, maybe some more challenges for servicers in the sense that if you have something that goes awry, then you have a lot shorter window to try to get them corrected or whatever. I mean, as you guys talk through strategy and launch and so forth, is that a topic of discussion internally for you guys on how you position yourself to be able to manage that transition from the longer term paper to the short term?
Yeah, I think servicer would like to have more 10-year deals on the books for a lot of the reasons that you just mentioned. One thing, if something does go wrong, you've got more time to work it out, but also just that portfolio building aspect of stacking 10-year deals gives you some certainty in your platform and revenue streams. And the 5-year has been a pretty drastic shift to the 5-year focus, and that changes a lot of things there. It also impacts that maturity wall that it's frequently talked about and adds to the peaks there that'll be upcoming after these most recent year deals. 5-year deals come up a lot quicker than people are used to. So it's definitely been a fascinating shift in the market.
Yeah, for sure. And you brought up the maturity wall there, and we've kind of internally at Trepp said we're not going to refer to the maturity wall anymore because there's a lot of people that are tired of hearing it. In fact, every time we write about it, we get some comment saying there's no such thing as a maturity wall. Everything gets worked out. But the reality is, if you look at the amount of maturities, like it just continues to stack up, right? So we can call it whatever we want to. What are your thoughts on that? Are you optimistic that this kind of extension, modification, kick the can, if you will, at some level is the best strategy for some of these assets broadly, or are we just delaying the inevitable? It feels like people, feel strongly one way or the other. I think at some level, to answer, I guess, my own question here is that for some of these functionally obsolete offices, we should just rip the Band-Aid off, take the loss, and let them reset the basis and try to become viable at a much lower basis. For these other properties that are still able to cash flow, but just maybe the value's been impaired, I think the extension modification route is the best path. But I'd like to hear what your thoughts are on that, because it's kind of hitting an inflection point, I think, where people are expecting the markets to either say we're going to draw a line in the sand and kind of curtail some of these extensions, or we're going to just go all in and say this is the path forward.
Yeah, I hesitated a little earlier to even say the term maturity wall because I know people are tired of hearing about it, and we've been talking about it for years. But it is real, like you said. It's not an Armageddon item, but it is real. It's not a one-time spike. It's a multi-year part of the cycle now, and we've got sort of a rolling approach to resolving things coming through this whole maturity cycle. And I do agree with you that there are certain asset classes like office that it feels like resetting the basis is the smartest thing to do. But I think for other things, the assets are holding up well. And if you've got a strong sponsor, you've got a good business plan, and you've just got some maturity pressures, I think the industry's doing the right thing by spending the time needed to work through those deals and protect relationships and not have unnecessary cemented losses when you just need some more time to get through this part of the cycle. So I agree with you there.
Yeah, I think that was a perfect level-headed servicer response there. Every deal is unique, and you have to look at the characteristics of that deal before making decisions. And so I generally agree. I mean, people can argue about the extension modification strategy, but on the whole, I think it's been overwhelmingly positive. If we looked at COVID and we surveyed the market participants and said, what do we think is going to happen to distress? Like, all of us would have been significantly more negative than what's actually played out. And I think a large contributing factor to that has been that borrowers, lenders, servicers, they've all worked to try to keep things that are, if a borrower is willing to work with you and contribute additional capital into the deal, if tenants are still paying the rent and they can cash flow, but they just can't refi into a new loan because of valuation pressure, let it keep making the payment and extend it out and then hope for things to change. I think it's been a net positive for the industry, because if we look at 07, 08, 09, when people just tossed the keys back, we saw what happened to the markets then. Liquidity dried up and things just went, to zero almost. And so I think it's been a positive, but at the same time, for some of these assets, we do kind of have to rip the Band-Aid off and see how that plays itself out, because we are delaying that inevitable part of the market cycle where you get the reset. If you don't take the loss, you don't get the reset. And if you don't get the reset,
Right.
Then you don't get the new investment capital into that building that repositions it. And like that part of the cycle has to play itself out. So, maybe give me, as a piggyback to that, where does servicing matter the most? I mean, is it bringing that level-headedness? Is it bringing an understanding of market dynamics? Is it leveraging data to try to get to the best outcome? Like, how do you perceive the role of a servicer, whether it be special or master? And like, what is the value add for that function in this market?
Yeah, sure. So if you look at monitoring versus resolution versus intervention, all critical parts of where servicing adds value in the process. I'd say servicing adds the most value in early intervention. Monitoring is essential, but that data without action sort of loses value. And resolutions where you submit outcomes, but by that point, a lot of the value's already been won or lost. So the servicing value add and differentiation comes in how quickly and effectively you can move from surveillance to action by engaging borrowers earlier, structuring solutions, preserving optionality, all well before a loan tips into default. We're in a cycle that's somewhat defined by maturity pressure and rate stress, and early servicer intervention is going to drive better outcomes than simply reacting at resolution.
I think that's a very salient point. We've had a friend of ours on our show, Rod Santamassimo. He coaches a bunch of the most high-performing brokers in the commercial real estate industry, and he has a saying that says, knowing isn't doing. And
That's right.
I kind of liken that to your, the data without action doesn't really change anything, right? You have to be able to jump in there when the time is right. And then that early intervention, I think it applies both to servicers and to borrowers, right? So do you have any perspective on borrowers that are struggling? I mean, I think the old adage was kind of just head in the sand until you had to deal with something, you didn't. But it feels like in today's market, borrowers are more informed if they can come to a servicer with a business plan or with something that maybe helps make the case as to why this is still a viable asset and they're still a viable, borrower sponsor. That early intervention on their side, I would assume, has to help.
Yeah, I completely agree. I don't know that I'd have to reference you to our special servicing guys and to give more specific examples. It's not something I see as much on the capital market side, but I think that early intervention is the key.
So when we're talking about data, I mean, what types of data, what are you guys looking at? Do you have a team that's analyzing the data for you? Like, just give us some color on like what role, because I know, in 2026, we can do things with technology and we can create insights and we can do things today that we couldn't have even dreamed of doing 10 years ago. And I know Grandbridge has been pretty proactive on the data side of the business. So maybe just pull the curtain back a little bit and tell us how you guys perceive data. What are you looking at when you're evaluating opportunities, et cetera, et cetera?
Yeah, so I mean, I think this launch of master and special servicing is a really good example of this. We, as I'm sure you would realize, we didn't just jump into this product launch without doing an immense amount of research, digging into the data. And my team and I became heavy users of platforms like Trepp over the past couple of years through this process. We dug into the data to better understand the players in the market and what the distribution of business looked like, and to understand, book runners and borrower sponsors and their roles and activity. And the data gave us insight into issuance volumes, current, historical, looking at low points in the markets to stress test our business case, and later on in the project, one of the things we did to validate our systems and procedures was to shadow service several deals in our test system that were live in the market, and we ran these tests over a period of several months. And so we went into Trepp and pulled deal documents and PSA, TSAs and prospectus and Annex A's and CREF C reporting and fed all that into our system. It was a several month test run that gave us confidence that we needed so that we could know that we were launching a robust platform. So, I'd say the availability of all that data was critical throughout this launch process.
No, that's really interesting to hear and very cool. I'd love to have been part of some of that internal shadow process, because you can learn a lot from running that exercise where your system has strengths, where it has some deficiencies, and you can correct those things before you launch. So I know we've talked quite a bit about the launch, right? So give us just is this platform available now? Is this something in the latter half of 2026? Like what does timing look like? Is it already in the market? Give us some color on that.
Yeah, we launched a couple of weeks ago officially. We're going through our first RFPs right now. So we're receiving deals and responding to those today. We've only launched SASB today. Conduit will be a couple months delay after this, but as of today, we're in the market for SASB master servicing. Special servicing, we can do anything. That product is fully launched, and we can do anything on the special servicing side.
Yeah, that's great. And market reaction and response, I would assume, has been positive. People excited to see a new participant in the space.
It's been very positive and been really welcomed as a new participant. The book runners have all been very engaging and accepting of having a new alternative in the market. The rating agencies were definitely very receptive to us. Our hiring, recruiting in the market has been really interesting because we've told our story in that process and seen a lot of really good reception there. And there's a certain type of person who hears about the opportunity to come out and build something new, build something from scratch. And you compare that with the market opportunity that we're showing, and people have been really excited. So that recruitment process has gone really well for bringing in some experienced talent. So yes, our market reception has been great. We've had a lot of participants fall out of the market in the past, since the GFC, but we haven't seen a new full service entrant in master servicing in 20 years. Plus, we see new special servicers all the time, obviously, but for master servicing, this is something new, and it's been received very well in the market so far.
Yeah, it's great to hear. I'm intrigued by the hiring process that you mentioned, because I do think the building component is something that employees are looking for in today's market. Like with all of the technology and tools and the availability of data that you highlighted, et cetera, being part of that and building something is very intriguing to this kind of up and coming crop of, potential employees. They don't necessarily want to work for something that's been established for 50 years and they're just like a cog in the wheel. They want to have some ownership, and they want to understand how their value directly contributes. So maybe highlight a little bit of that. It sounds like you're seeing that same thing as well.
Yeah, 100%. And, part of that whole conversation with candidates is that early on, while we were going through the project to launch this, which was, well over a year-long process, part of that conversation is that, hey, we don't have a direct playbook on how this is going to roll out. We need you to come in and help us build this and help us figure out what the right way to build this thing is. And, we're not limited by what the service offering is in the market today. If there are things that we need to change and to make this a better product for the market as a whole, that's what we want to do. We want to offer a differentiated product and, a higher touch product and something that's more focused on data. And, I have one associate on my team that I hired as part of this process, and he's really latched down to the data aspects of it. And like most companies, we've got a big AI push, and he's been labeled early adopter in AI and is helping us really drive how can we use some of these tools more efficiently and throughout this process to build a better process. And that's been really, really fun to watch and be a part of.
Yeah, we're seeing the same thing. Obviously, as a product company, we're really leaning into the AI stuff. I think there's some central tendencies of people just wanting to have some ownership, and being able to create data insights that they couldn't do 10 years ago is really a motivating factor for a lot of people that we see. Is just they can see their work real time. And it used to be like, maybe it gets populated in a spreadsheet, or there's, someone writes a SQL query and they pull some data out or whatever. But you can literally sit in front of Claude now, and in 5 minutes, you can pull in data from all these different sources and create a slide deck that is amazing. It's exciting for you guys. It's exciting for us to hear from you about how that the market's being receptive of this. And to your point of having a new entrant over the last 20 years, you guys bring a lot of reputational expertise and so forth from the market's perspective. So I think it's going to be really great. So maybe last two questions. One, kind of sticking with the theme of hiring, is just, as someone that's now spent, a fairly good amount of time in the commercial real estate landscape in various roles, what would you give us some advice to maybe people that are coming into the CRE industry as a newbie, right? So we try to get our seasoned folks that we have on as guests to kind of give some life career advice for people that are just starting out today. So if you were talking to a group of graduating seniors, what would you tell them as it pertains to joining the CRE ecosystem?
I guess a few things, be ready for the ride, because it's a cyclical business and that's not going to change. So that's something they've got to understand and be ready for. But I think it goes back to what we were just talking about in the data and embracing AI. I think the people that can step into a business and show value in implementation of AI today are the ones that are going to get the reps with senior management. They're the ones that are going to excel. And if you're not doing that as a new entrant into the workforce, you're behind already when you start. So I would say that's got to be the biggest focus. And that's how they're going to get noticed. And that's how they're going to get their reps is driving how AI and that data focus can be implemented.
Yeah, I totally agree with you. I think that is the number one differentiator, in my opinion, of people that are going to be super successful versus those that are just going to be a contributor is their willingness. It's like that intellectual curiosity coupled with action. And it goes back to what you said earlier, data without action doesn't really do anything. And same thing goes for people. You got to leverage the tools that you have to create some action. So I know you said, and we acknowledge that maybe the market timing was not a catalyst for your guys' entry into the space. But as you just said, with this business being cyclical, what is something about this cycle, and this will be our last question, what is something about this cycle that we'll probably look back in 5 years and it'll be misunderstood? Is there something that we're really focused on today that we shouldn't be? Or is there something that we should be focused on that we're all just missing?
Maybe we're not all missing this at this time, but maybe the big realization will be that CRE is not monolithic and that this wasn't a single cycle, but maybe several overlapping ones. I think initially people expected the familiar quick V-shaped rebound with broad recovery like previous cycles. And that's where the whole survive until 25 mantra a couple of years ago showed that. But we've really got multiple shocks at work from, an office reset, the maturity wall and those complications and, implementation of more disciplined capital markets underwriting and uncertainties around tariffs and wars and interest rate shock, all those things happening at the same time, and they're all getting worked through in different ways and at different paces, and that's causing a unique recovery cycle. So maybe that overlapping cycles versus a single one will be more clear.
I think that's a home run answer because we joke on our weekly show that we've basically lived through 100 years worth of crisis in the last 5 years.
Yeah, for sure.
And it just it's not appreciated enough because we live in this constant news stream world now where, today's headline is only good for today because it gets replaced by something even worse tomorrow. And we've kind of become desensitized to it. But for the things you just mentioned, if you went back 20 years and any one of those things happened, they by definition would have cratered the market. And now we're dealing with all of them simultaneously and the market's proven resilient. So I think that's a great answer. And I think this will go down this like 5+ year period of COVID to maybe 2028, 2029, whatever. People will look back on that and to your point and say, man, this is like 6 or 7 different things all at once. It's amazing how the markets just were able to navigate. And we didn't really touch on it today, but I think private credit has a lot to do with that. I mean, there's a lot more sophisticated capital available outside of the pure banks and some of the traditional lenders, which has really created a buffer, I think, to some of the distress. So if you have a comment on private credit, feel free to jump in there. If not, I said we'd ask the last question. We did, but I think we could have a whole show on private credit if we wanted to, because it's been a huge differentiator, I think, in this cycle relative to the previous ones.
Yeah, I completely agree. And, I spend a lot of time with debt funds because from a servicing aspect, but also just in understanding their business and tying in with the bank where we're doing warehouse lending to those guys. And I think it's been fascinating how, working for a big bank, seeing private credit, and as we move, them shifting to fill in gaps, and not only that, the banks lending to private credit is a whole another thing you could have a whole session on, and because of the impacts of regulations and regulatory capital and how that change doing your lending through private credit versus direct, and how that changes regulatory capital impacts and of your capital you're putting to use. Those things are all fascinating.
Yeah, we agree. And Haley's going to take us out here. But for those listening to this guest podcast episode, if you go back and listen to the TreppWire Podcast episode 403, Stephen and I go through a pretty extensive deep dive of some of those regulatory hurdles that are avoided if you do warehouse lending to some of these private debt funds and some of the other institutions where it's very advantageous for banks from a capital perspective to leverage some of these other alternatives. If you want to do a deep dive on that, you can do a quick listen on 403 and that'll give you a pretty good primer. Yeah, so that's my plug.
Well, thank you, Marty. This has been an excellent episode. And, we appreciate your partnership and all that you've done in the industry. It's really cool to hear your personal growth, your firm's growth, and then we have to congratulate you on the launch. So We're excited to see all that happens at Grandbridge over the next several months and years. And before we close, if our listeners want to learn more about your new business or your firm in general, how can they reach out to you or get in touch?
Yeah, the easiest way is email. It's marty.allen@grandbridge.com. Pretty simple. Or feel free to reach out on LinkedIn.
Awesome. Well, thank you again for joining us today. We really appreciate your partnership.
Yeah, thanks for having me.
With that, we'll close this special guest podcast. Thank you, Marty, for joining us today. Join us later this week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com. Until then, visit trepp.com for more info and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.